Disclaimer: stock trading is inherently risky and the users agree to assume complete and full responsibility for the outcomes of all trading decisions that they make, including but not limited to loss of capital. Matthew, chapter 25 verse 14-30, For it will be like a man going on a journey, who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, to each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money. For today's video, we are going to talk about how to know when to give up. Individual equities don't always follow stock market indices, and many underperforming ones might lose money for a long time. Individual investors sometimes hold lost equities anticipating a comeback, only to watch them decline further. Individual equities don't always follow stock market indices, and many underperforming ones might lose money for a long time. Individual investors sometimes hold lost equities anticipating a comeback, only to watch them decline further. One of Wall Street's most enduring proverbs is "cut your losses short and let your winners run." Although this is sound advice, many investors appear to disregard it, selling stocks after a small gain only to see them rise, or retaining a stock with a small loss only to see it decline further. No one will intentionally purchase a stock they believe will lose value and be worth less than they paid. Investing, however, necessitates the acquisition of declining equities. Therefore, the objective is not to avert losses, but to minimize them. Successful investors are the ones who recognize a capital loss before it spirals out of control. In this article, we'll help you stand out from the throng and demonstrate how to determine when to act. Despite the rationale for limiting losses, many minor investors are still left holding the purse. Eventually, they amass a number of stock positions with substantial unrealized capital losses. At best, it is dead money, and at worst, its value declines further and never recovers. Investors typically believe that the reason they have so many large unrealized losses is because they purchased the stock at the incorrect time. They may also believe that it was due to poor fate, but rarely believe that their own behavioral biases are to blame. Realizing capital losses. Oftentimes, you are forced to sell your stock at a loss in order to prevent further losses. Hope is not a strategy, and holding a negative position requires a logical justification. The price you paid for a stock has no bearing on its future performance. The price of the stock will rise or fall based on market forces, its underlying fundamentals, and its future prospects. Let's examine a few methods for preventing a minor loss from turning into wasted money or a much larger loss. A documented investment strategy that includes a set of rules for purchasing and selling stocks will provide the discipline to sell stocks prior to the onset of significant losses. The strategy could be based on qualitative, quantitative, or fundamental factors. In conclusion, it is always a smart strategy to take corrective action before your losses worsen. In investing, it is not always possible to avoid losses, but successful investors embrace this reality and instead attempt to minimize their losses. Receiving a tax credit when you sell a stock at a loss is one of the benefits you will enjoy. Another advantage of selling these dogs is that you will not be reminded of your past error every time you view your investment statement.
That's all. Thank you for watching. I hope you learned many new things about the stock market. Kindly subscribe to our channel and click the notification bell. Also follow us on our Facebook page to learn more about the stock market.